Hi, welcome to VCCircle. We are here with Mr. Gaurav Dalmia. Mr. Gaurav Dalmia is a part of the Dalmia family. The Dalmia Group, which is run by the family, was started by Mr. Ramakrishna Dalmia and his younger brother, Mr. Jayadayal Dalmia, in the 1930s. Today, the group has interest in cement, sugar, olive, hotels and textiles, among many other industries. Mr. Dalmia himself has been a very bullish investor and has been investing in various companies. He is the founder and chairman of Landmark Holdings, which invests in real estate projects. He is the managing partner of GTI Capital, which has recently invested in companies like SAMI, NSE, Battle Foods, and he is also the founding sponsor of India Value Fund, Infinity Ventures and Evolvence Fund. Mr. Dalmia, thank you so much.
Thank you
For joining us here. With Landmark Holdings, can you first give me a little bit of introduction about it and what is the corpus and what kind of LPs are there in the fund?
See, Landmark invests mostly in housing projects and housing related projects.
Mm-hmm.
And beyond that, we have a bottoms up view. We have no preference of markets or instrument or type of developer that we work with. But we tend to work with leading developers in their home markets. So if one of the big North Indian developers said, I want to go conquer Chennai, we simply won't be interested in going with them. Mm-hmm. And we'd rather work with a smaller developer in Chennai, in his own home market. We like housing because housing is self-liquidating in nature. It's not obvious on day one to many people, but a lot of funds have now veered towards housing. But if you saw the initial rush of capital, a lot of it went towards shopping malls and IT parks and offices and this, that and the other. And from day one, we were focused on housing because exits in housing are very easily definable because projects self-liquidate and return capital. Mm-hmm. So those are two kind of basic parameters. Other than that, we are fairly opportunistic.
Right. And what is the corpus of Landmark?
See, Landmark has a moving corpus in as much as it's not a fund.
Mm-hmm.
So we have what is known in the investment world as separate accounts. And separate accounts are large institutional investors who do JVs with people like us. Mm-hmm. And they invest. And our minimum investor size is $100 million. So we don't take small amounts of money. A fund would take $10, $20 million slugs of capital. Right. From various people and raise $200, $300, $400 million,
right.
And we've raised about that same amount, but just from 3 or 4 investors.
Right.
And therefore, every time we go raise new money, our corpus goes up by a pretty large amount, and then it is depleted again because we use it up,
right.
And so on and so forth. Sure. And we don't have formal capital raising the way it works in a fund. One fund gets exhausted, the next fund gets raised, and so on. A lot of our capital is somewhat parallel to each other.
Right. So, if at present, what would you say? What is the corpus and what is, let's say, assets under management?
In the range of about $400 million.
Okay. And what kind of LPs do you have, if you can mention any?
We don't mention names, but we have large institutional investors, and those are the capital. That's the kind of capital we'd like to attract, and that's the kind of capital that likes to work with us.
Sure. And you're saying you invest in housing projects. You're looking at both equity, debt, mezzanine funding, or do you focus more on equity? How do you strategize?
By nature, we are equity investors, and we like to do equity deals. Mm-hmm. Depending on market circumstances, we may do a mezzanine deal or something like that. Now, there are two ways to approach a mezzanine deal. Mm-hmm. So there's a lender who is saying, I don't want 13-14% return on my money. I want to increase the return, let's say 18%, and I'm willing to take slightly extra risk. That's one way for someone to approach mezzanine. We have an opposite way of approaching mezzanine. Mm-hmm. We are equity investors at heart, but under certain circumstances, we see a lot of downside risk. So we are saying, can I take slightly less risk, slightly lower return, and move from equity to mezzanine? So I'm moving towards the same 18, 20%, 22% number, but I'm moving from taking higher risk to lower risk, not from lower return to higher return, which is what a typical lender is doing.
Right.
So our approach is that of a private equity investor, not of a lender. And so if a mezzanine guy comes and tells us we can give you any coupon, that's fine with us, as long as we make a good return. So we are very creative, or can be very creative, in structuring a deal which looks and feels like equity to the counterparty concerned,
right,
but manages some of the risks we don't want to deal with through an equity mezzanine structure.
Is the risk appetite of investors increasing in real estate because the kind of markets that real estate is seeing right now?
I think the risk appetite for investors is actually decreasing. If you look at what's happened in the last 4 or 5 years, firstly the honeymoon with real estate is over. So the rush of capital that came in 2003 to 2006, right, had fancy expectations and this, that and the other, and all that is gone. Because after 6 years, people are saying, we are somewhat disappointed, or we are not doing as well as we expected, etc. So that honeymoon capital is over. Secondly, I think people's return expectations have been moderated. Projects have been slower than expected. The rupee has been hurt. So even if people had made good rupee returns, the dollar returns have been somewhat hurt.
Right.
There have been a lot of issues, and you've read about them, whether they're litigations or this, that, and the other. Some people have been spooked along that dimension.
Right.
And I think people are being far more selective today. I think 80% of the people who were in business in 2005, 2006 are not in business today. 70% of them are not in business, and most of them will not come back into the business.
Right.
So if you're a global fund, many of them are saying, why bother with India? I can make better money elsewhere.
Right. So is that why people are going, or investors are looking at mezzanine and debt more than private equity?
I would say from a risk management point of view, some people are looking at mezzanine or debt more seriously. I also think it's a little bit more esoteric. So they burnt their hands in equity, so they're saying, let's try our luck with mezzanine. To some extent, that is a misplaced strategy.
Right.
Not everyone is doing that, but some people are just doing that because that's their only hope.
Right.
They've been kicked, in the equity side.
Right.
Mezzanine is actually a decent product for some of these housing-related investments.
Right.
So I would think there would be reasonable demand from the developer perspective, and I would think there is a reasonable supply from institutional capital as well. Although it's become a little bit of a fad to do mezzanine. So when banks are finding that their senior loans are getting hurt and they're not getting paid, equity is finding on the other side that they're getting hurt. For the mezzanine people to pretend that somehow they'll make very good returns, while senior and equity will get hurt, is misplaced confidence.
And talking about investors getting spooked by by this industry, there have been a lot of stories about people having, not having the right experience with developers. Did you face any of that yourself?
Well, there are 2 or 3 levels in which we face challenges. One is every project is a startup, and therefore it has its own startup risks. So a business plan never gets followed very, very neatly because every project has its own startup type of risk. And some people get spooked by that. We've gotten spooked by that in our own way, but we know that that is to be expected in some ways, and therefore we try to get our handle around it and solve those problems rather than panic when those problems arise. A second type of problem we faced is quality of development partners. Sometimes what happens is the underlying land bank is so powerful and so strong, and you're so attracted by it, that even though the developer may not have a good history, you somehow shut your eyes to that fact. Right? And you go in bed with a developer who otherwise you would not partner with. And we've not really had any very bad experiences, but we've had developers who try to pull off their shenanigans on us, and then we have to really react. And we've reacted aggressively. We've separated projects with developers who were trying to play the fool with us, and we've taken over the projects and so on. But I should also tell you that many of the problems that people face are of their own making. Many of the developers are actually very good. We've had a deal which went wrong in as much as all the economic parameters of the deal went wrong. And we had a put option at 15%, and we had all the upside. And we went to them and said, look, we want to exercise our put, but we will not do it at 15%, we want 18%. And the reason is, we were not trying to protect ourselves against you, we were trying to protect ourselves against the market by the put. But look at the mess up that your guys have done. And he agreed, and he actually gave us an 18%. So for every foreign bank who's fighting to get his 15% out, we were able to get 18% on a 15% contracted number.
So it's been both good and bad.
It's been good and bad. So I think it depends on how you approach the business actually.
For a fund like Landmark, apart from the aspects you mentioned, any other aspects why you just look at housing projects? Why not other real estate projects as well?
See, first of all, housing is a very deep market. So you don't have to do housing only in a Delhi or a Mumbai or a Bangalore. You can go to 25 markets which have a population of more than 1 million people.
Right.
It's a very deep product. The office market may be 7 markets in this country. If you go into the 8th largest city in India, what's the depth of the office market? Virtually none. Okay. Retail may be slightly deeper than office, but also not very deep. Okay. So first is just the market size and depth. I think housing is a far more flexible business than other asset classes within real estate. Secondly, I think price discovery in housing happens very, very easily and quickly. So your risk management can be very easy. In a shopping mall or office, you build the building, 70% of the building is done, that's when you discover what your rental levels will be. right? So your price discovery happens pretty late in the game. Thirdly, you lease the building, you lease the shopping mall or whatever, and then you want to exit. There are yield buyers out there, right? Those tend to be high net worth investors because REITs don't exist. So your classical exit mechanisms are not in place. So it creates its own challenge. So there are so many low-lying fruit, and in the context of India, what is a couple of $100 million? It's nothing. So for us, just stay with the low-lying fruit, which is housing.
Okay.
Many investors in their early days didn't understand this difference. So if you gave them a choice, will you do middle market housing for middle class India, or will you do office space for IBM? Many of them said, oh, office space for IBM sounds a lot cooler, neater, easier, less risky, etc. compared to middle market housing. And you can see office guys have done nearly not as well.
Right.
As the housing guys, most PE funds today focus on housing as a result. And this wasn't so obvious in 2005, 2006 for many of the people.
But housing has its own challenges, and correct me if I'm wrong here, but what I've come to know is that the inventory is rising and people aren't really buying because the houses are extremely expensive. Is that something you're facing yourself as an investor? Does that make you nervous?
I think in the near term that's a very big concern, and that is a very big concern especially in the greater Delhi market, where inventory levels are at historic highs. I don't think Bangalore or Chennai or even Bombay has that kind of inventory build-up. Delhi is very speculative by its very nature. We have a very bottoms-up view. So for example, in today's world, we are not really playing in Delhi because of this reason.
Okay.
We are playing in smaller suburban markets. So for example, we are just invested 3 months ago in Dharweda. Dharweda is a suburb of Gurgaon with its own limited demand supply, middle market product, 25 lakh rupee homes, not really competing in the speculative bubble of Delhi or Gurgaon or stuff like that. So we are fairly bottoms up oriented. We can play tier 2 markets. Personally, in this circumstance, I prefer tier 2 markets than the big tier 1 markets.
So in terms of quantum, do you also earmark a certain quantum of investment year on year? That you look to invest a certain capital every year?
Not really. We are very, very opportunistic and bottoms up. So if there's a good opportunity, we'll invest. And if there's no good opportunity that comes our way, we can stay silent for a year. It doesn't matter. So we don't have a quota per year.
Before I come back to Landmark, I want to touch GTI Capital as well. So you're the managing partner of GTI Capital, and it has some very, very well-known names as LPs. So could you tell me about how GTI Capital came together? What kind of LPs GTI Capital has?
You would think of GTI as a club, which is somewhat institutionalized, and we have super high net worth investors from Wall Street, essentially. And we are opportunistically looking at deals. So we again don't have a theme. So it's not that we will do middle market growth capital or buyouts or A or B. And we've done from buying a 0.5% stake in the National Stock Exchange to seeding a hotel platform. And we continue to be fairly bullish about India. Now, given that we are so bullish, we can have two different strategies. One is, I'm going to pay huge premium for high growth. Guess what? We are not going to do that. A second strategy we can have is, we'll pay reasonable premium for moderate growth, because I see moderate growth all over the place, which is a part of our maximum bullish view of the world. We'll pay reasonable prices for moderate growth. We will not pay high prices for high growth. And we can still say we are maximum bullish.
Right. And how GTI Capital works is that you co-invest with your LPs.
Yes.
So first, so you told me HNIs from Wall Street, but what kind of HNIs? Who are the LPs in GTI Capital?
We don't kind of advertise their names, but it has people like former chairman of Morgan Stanley, managing partner of Goldberg, Kravis and Roberts, and so on and so forth.
Right.
And everyone has their own sweet spot, so nobody is obliged to invest in every investment.
Right.
They all have their own sweet spots, and they co-invest in particular.
So you look at a company, you identify a company, and you invest in that company. That's GTI Capital, and you co-invest. One of your LPs would come along.
One or five.
Yeah, whatever number.
And so we'll put in, let's say there's a $50 million deal,
right.
We'll put in 10 or 20 of our balance sheet. 30 or 40 may come in from our co-investors.
Is it a corpus of GTI Capital?
Unlimited.
Certain fund size, the GTI Capital. Okay.
Well, there's no corpus, but we have our kind of practical sweet spots. Our practical sweet spots are 10 to $30 million deals.
Right.
Because those deals we can close fairly easily. $100 million deal, even with our investor base, becomes a little bit more challenging to close in a very quick time frame.
Right. How do you identify companies? Because again, it's a sector agnostic fund.
See, one of the strategies we have for now is to buy out exiting private equity. I think there's a lot of pain in the private equity world. The natural timelines that private equity funds are facing to close their fund down and raise new capital. And therefore there's an institutional imperative, so as to speak, to exit. We want to take advantage of that. So we are in the market to buy out existing private equity who want to exit their deals.
Right. Any sector.
Any sector. If the valuations are right. And we think we'll get better valuations out of them as compared to putting new money into growth companies.
Okay.
Of similar size, scale, whatever.
Okay.
And that's the hypothesis. Based on that, we made a bunch of investments which are secondaries. We made a bunch of investments that are primaries. Of growth.
Right. It's very interesting that you're looking at secondary because it comes at a time when the PE promoter issues have really started coming up, and one does read about so many times that PE players and promoters are not getting along. A lot of those secondary deals are at depressed value because of that also. So when you look at investing in such a company where probably the private equity player had a problem with the promoter, is selling off his stake for maybe a depressed value, how do you look at a deal? Would you still look at that deal? Would you still look at investing in it?
We would not really say no to anything. We would look at it. If the promoter is not a high quality promoter, we would have no interest. So if the dispute is simply because the PE investor is tired and he's creating a dispute for the sake of it, which also happens, we are fine with that. But if the promoter is not of good quality and the PE investor has a genuine dispute because there's fraud or there's misrepresentation or this or that, that's his problem. We have no desire to take over his.
And how spooked are you becoming with the recent, because a lot of stories are coming up. It used to not come up in the mainstream as much as it started coming up now.
No, I think private equity investors have gone into projects without using their brain, I'm sorry to say. And to some extent what they are getting is what they deserve.
Okay.
They've been very seduced by growth. Right? They've ignored promoter quality as a result. So as growth tapered, right, the promoter quality issues came up.
Whenever you invest, if you face a problem of that sort as a GP, what kind of options are you left with? How do you analyze such a circumstance?
First of all, for us, the promoter is the most important thing. The project or the underlying business is not.
Okay.
Right? Because promoter makes a business. Infosys happened because of its founders. Right? Wipro happened because of its founders. XYZ company happened because of its founders. Right? And to us, therefore, that is the single most important variable. And the amount of energy and time we spend on that is quite extraordinary. So the chances we'll get spooked by that, I won't say they're zero, but they're lower than average.
Okay.
Secondly, once we do make an investment, we think of ourselves as pure partners, not as mere financiers. The difference between that is actually quite profound.
Right.
A partner will say, look, you have a problem, I'm your partner, how can I help? You're the promoter, we have a problem, it's our problem. A mere financier will say, you Mr. Promoter promised me A, B, C, D, E, it's not happening, you're an idiot. Right? Our approach is the former.
Okay.
So we don't fight with promoters because there's a missed target. We don't fight with promoters because we got surprised in a negative fashion of late. Right? We tend to solve these problems. And if you catch these problems early, they're actually solvable.
And is this because the investment philosophy of GTI Capital and Landmark is very different?
I think it's our personal temperament.
You don't have a fund size, you don't have that kind of a pressure that you have to exit within X amount of years.
So first of all, I think it's our temperament.
Okay.
Secondly, if you do want to make 25-30% IRR, right, you can't make 25% IRR by sitting in a living room. Either your timing has to be perfect, market conditions have to be so benign that you've got damn good valuations. That's possible. Otherwise, you have to really get your hands dirty and build businesses. And if you don't have that skill, temperament, you will not make a 25-30% IRR. Warren Buffett became the second richest man in the world only with a 23% IRR. So if 25% was dead easy, Warren Buffett wouldn't be God.
What was the last investment that GTI Capital did?
The last investment we did was actually National Stock Exchange, and we invested in 2 phases over there. And we are now actually looking at very closely at a real estate deal along with Landmark.
Okay. So GTI Capital and Landmark would invest together? Okay. But the NSE you were saying, so how much did you invest in the NSE?
It's a confidential number, but
When you invest in a company, how do you value it? I mean, I know it's a fairly broad question to ask you. It's a very important question, especially with if a company is a startup or if it's a mid-level company. On what factors do you value that company?
see, I think we have a fairly disciplined approach to creating a business plan and then using discounted cash flow.
Okay.
Now, what happens is many private equity types build a very aggressive business plan, right? And they take a very high multiple during exit time, that you will exit at a very high PE or EV to EBITDA multiplier, and that's where they go wrong. So we try to build a reasonably conservative business plan with a reasonable exit multiple. And two things have to happen. One, we believe that the investment that we made, the earnings will grow, and they will grow at a rapid pace. Okay. Let's say at 20% per year over the next 3 to 4 to 5 years. Secondly, we do believe that there must be an earnings expansion between the valuation we are paying and the valuation at which we exit. So if we are getting in at, I'm making up a number, 10 times earnings, we will exit at 12 times earnings.
Okay.
Okay, not very aggressive, so it won't go from 10 times earnings to 20 times earnings. So on earnings growth, which is good, and small PE expansion, we believe we can make a 20%, 25, 22%, 23% IRR. So we don't play for 40% IRR, this, that, and that. Those are upside considerations. That's not our base underwriting. Our base underwriting has to be mid-20s to early 20s on a fairly conservative basis. And if it doesn't happen, we simply won't invest. We won't get seduced by someone throwing some 35% IRR number at us.
Right.
I'm saying, how many people have done it? Chris Capital's done it, India Value Fund's done it, one or two others have done it. Bulk of the private equity industry has made 15%, thank you very much. So let's not lose sight of that empirical evidence.
Right.
So
So your expectations are very realistic in that sense.
low expectations never got disappointment, my friend.
Right. How challenging is it becoming now to raise capital for private equity investors? Are LPs becoming more anxious now?
I think the world of investors is getting tougher and tougher. Some of it is a comment on India. The Indian returns have disappointed people. The risk premium that investors demand out of markets like India, they're not getting. It's not that the absolute returns have been very bad, but for the risk they perceive that they're taking, if you're getting 15-17% returns, it's simply not worth it for people. Secondly, I think returns are very skewed. 20% of the people have made most of the returns, and I think those 20% will get a lot of capital. So if Chris Capital raises its flag and saying, I want to raise money, they'll get oversubscribed.
Okay.
Right? But an average player raising his flag and saying, I want capital, I don't think he's going to get full subscription anytime soon.
What about LPs? Have LPs started participating more, or do LPs have
I think
LPs
they've started also
looking
screening.
Looking at
Absolutely.
what kind of investments private equity players are making with their money?
Yeah, they started screening. See what was happening was, this industry started really in 2000. Think of this as the 13th year. First 5 or 7 years, you were betting on stories, resumes. Today, you're basing your investment decisions on track record. Completely different world.
Okay.
So an LP will say, fantastic, you have a great story. Tell me, how much money have you made again in the last 5 years? 0 or 15%, or you're brand new or whatever? The hurdle just went higher.
Right.
Versus somebody said, look, I've been doing this for 15 years, right? On this much capital, I made a 17% or a 20% or a 22% IRR in dollars after all the problems of the Indian economy, right? And I think going forward, I can do A, B, C, D. Far more compelling story.
And talking of problems with the Indian economy, the rupee fluctuation is a big problem for private equity players. Also for you, because again, as a private equity player, a lot of money is coming from outside and you have to make returns and send it back.
Indian inflation and earnings growth makes up for our loss on the rupee side because we are equity investors. The rupee doesn't devalue in a linear basis every year. So you may have a stable rupee or a strengthening rupee and then suddenly a big hit and then stable again.
Yeah.
Okay. If you take a 7 to 10 year view, our last year's story need not be the bad news. The devaluation hurt may be less when you amortize that over a 5 to 7 year period.
Okay.
Okay. And therefore, to some extent, we can live with it. So we are not that concerned about the rupee dollar issue as much as how do we make good rupee return.
Right.
You know what, if I can make a good rupee return and get hurt on the rupee dollar, I think investors will forgive us.
Okay.
But if I make a bad rupee return and therefore a dismal dollar return, I don't think we'll ever get forgiven.
Right. Thank you so much for answering all the questions, Mr. Dalmia. It's a pleasure to meet you and look forward to seeing you again.
Thank you so much.
Thanks a lot.